Hello everyone, newborn investor here and welcome to another video. SOFI stock price dropped by almost 14% last week after the company released their second quarter financials. Although the earnings report had some bad news, I honestly feel that SOFI did not deserve that kind of a dip. So what went wrong and should you be selling? In today's video, we are going to talk about it and many more, so make sure to stick around as we're starting right now. SOFI's earnings were disappointing, especially for short-term investors. The company missed its earnings per share estimates, reporting a net loss of $165 million. A bad quarter does not mean that the entire company is doomed. Digging deeper into the earnings report, I have 3 takeaways that tells me to buy the dip. So what are they? We will get to it in a minute, but before that, if you like the video and find it valuable, please make sure to hit the like and subscribe button. I really appreciate your support as it keeps me motivated to put in the long hours for making these videos. Alright, let's move on. SOFI is down over 37% over the past 6 months, out of which a 14% drop came in after the company posted its second quarter earnings. The earnings sell-off was triggered by the fact that the company reported a net loss of $165 million compared to a profit of $7.8 million in the previous year quarter. This was totally unexpected, causing many investors to unwind their positions. However, the company gave some decent explanations as to why the earnings were far off. The net loss was mostly due to one-time expense in relation to the Galileo business combination, as well as non-cash items like stock-based compensation. These expenses likely won't repeat and may not turn out to be a major problem. In spite of that, SOFI generated positive EBITDA, which suggests that the core business is profitable. If you have been following SOFI, you may already know that SOFI started with student loan financing, and at one point it was the main driver of growth. However, as part of the pandemic relief, government has frozen most student loans and interest payments have been halted. CEO Anthony Noto estimates SOFI to lose around $40 million on student loan refinancing over the last 6 months of 2021, and that explains why the company did not raise guidance. I hope it's a short-term hit and revenues from student loans should rebound once the moratorium on loan payments is behind us. Despite reporting a net loss, SOFI's core metrics show impressive growth. Adjusted revenue for the quarter grew by 74%. Member growth was at 113%, reaching 2.6 million members. Total products increased by 123% to 3.7 million. And finally, Galileo, SOFI's financial tech platform, reached 79 million accounts, representing a 119% growth. SOFI's full year guidance is around $980 million, and with a market cap of $12 billion, SOFI stock is currently trading at a price to revenue factor of 12. For a fintech company with diverse offerings, I think the company is undervalued. To me, it looks like a dip buying opportunity, and that is exactly what I'm going to do. Apart from the hiccups due to one-time expenses like stock-based compensation and tax liabilities recognized in connection with Galileo acquisition, the one thing that hinders me is student loans moratorium. However, the moratorium is expected to end by Jan 2022 as per the current guidance, and if it does not get extended, SOFI should be back on track, offering great returns for its investors. For all these reasons combined, my outlook on SOFI remains unchanged, and I'll be continuing to hold and grow my position in SOFI. Now, I would love to hear from you guys. What was the one thing that you did not like about SOFI's recent earnings? Leave a comment below with your answer and I'll be sure to follow up with you. Also, if you liked this video and found it valuable, please make sure to hit the like and subscribe button. I really appreciate your support. So until you hear from me again, stay safe and thanks for watching. Bye.